What's the difference between an index-based fund and an exchange-traded fund, or ETF? Good question. This is something that most people don't actually know. First, let's reiterate what an index-based fund is. An index-based fund is simply a fund that tracks a benchmark index or indexes. Index-based funds are commonly referred to as passive investment strategies. This is as opposed to an active investment strategy, where the goal of the fund is to try and beat a benchmark on a risk-adjusted basis. Risk-adjusted means that the performance takes into account the volatility of the fund. For example, if a fund manager picked stocks that were very risky and the fund was wildly more volatile than the index, but only beat the index by a small amount, they actually did a poor job of managing the risk and return of the fund. The truth is that either strategy, active or passive, can be used by a fund that is traded on or off an exchange. If a fund is traded on an exchange, it's referred to as an exchange-traded fund, which is often shortened to ETF. That means you can find either passively or actively managed funds that are traded on an exchange and are therefore both fully qualified to be called ETFs. You can also find funds that don't trade on an exchange that are set up to be actively or passively managed. So the real answer to your question, what's the difference between an index-based fund and an ETF, is that they are actually separate concepts altogether. An index-based fund is an investment strategy, and an ETF is one of two main structures for a wide variety of investment strategies. The reason there is confusion here is that most people, even in the industry, tend to incorrectly refer to index funds and ETFs as the same thing. Similarly, many people refer to mutual funds and actively managed funds as one and the same. But again, one is a strategy and one is a structure.